What's up YouTube? Dougie Chong here. Welcome to today's episode where we're going to go over the current general market conditions and answer the big question of if we are in a current AI stock market bubble. Before we get started, if you like these types of market breakdowns, be sure to smash that like button and hit subscribe. It really helps the YouTube algorithm. Alright, let's get right into it. So when we look at the broader market, one of the things people usually point to is valuation. Specifically, the PE ratio or price to earnings ratio. This is the price that investors are willing to pay for a company per dollar of earnings. Right now, the average PE ratio for companies in the S&P 500 sits a little bit above 25. Historically, that is slightly elevated. The PE ratio tends to sit and hover around that 20 mark. But what's interesting here is when you zoom out and look at the extremes, you can really see how stretched out things can get. During the dot-com crash, we saw PE ratios in the 50s, and during the financial crisis in 2008, we saw PE ratios well over 100. So when people say this feels like a bubble, it's important to ground that in data. On a pure index-wide basis, we are not at those extreme levels quite yet. We're elevated, yes, but we're not in a full-blown mania territory. Now here's the part that makes this cycle different from the others. A lot of the biggest drivers in today's market, especially those big mega cap tech companies and AI related companies, have real earnings behind their price points. These aren't just stories or projections, these are real revenue growth, real profit expansion, and in many cases, real supply constraints. Take the semiconductor space as an example. Companies like Samsung, Micron, and SK Hynix are seeing unbelievable demand for their memory chips. The entire industry is being pulled forward by data center expansions and AI infrastructure buildouts. This is not speculative demand, this is real orders, real world deployments, and contracts. At the same time, companies are racing to build data centers at a rate we have never seen before. So on the surface, it does make sense why valuations have stayed elevated for so long. Earnings are growing into their prices, at least for now. But with that being said, we can't ignore some of the cracks or risks that people are starting to talk about. One of the biggest concerns right now is something called circular investment flows. And this is where things get a little complicated. For example, you might see a company like Nvidia invest in OpenAI, and then OpenAI goes around, uses that money, and buys GPUs back from Nvidia. So in fact, money is flowing through the ecosystem and coming back as revenue. Now to be clear, this doesn't mean anything fraudulent or necessarily anything negative. In fast-growing industries, this type of ecosystem reinvestment can tend to happen naturally. But the concern is that it can exaggerate what the demand really is, and if the demand is really sustainable or not. People often compare this to the 2008 financial crisis, where banks would package and then repackage debt and distribute it to others. Now this is not the exact same thing because that was toxic leverage and bad debt being layered repeatedly over and over. Here, you're dealing with actual products and real infrastructure spending. But the psychological pattern of money reinforcing investments is something that investors are looking at very closely now. Now, let's zoom out and look at some of the mega cap names today, because this is what really drives the market. Companies like Nvidia, Microsoft, and Meta are not just big, they are index defining. Their performance heavily influences market direction in a way that smaller companies simply don't anymore. Nvidia stock has actually stayed close to that $200 mark for close to a year now. However, that price is after a massive run up, and it is now the most valuable company in the world today. Microsoft stock is around $400, which is down about $100 from its all-time high of $500. Meta stock is down about $150 from its all-time high around $750 last September to around $580, $590 today. All three of these stocks have come down from their all-time highs set around last September. History will tell if that was the top, and this is the beginning of the AI bubble pop. And when you pair that with ETFs like VFB, which tracks the performance of the S&P 500, you can see why the index can stay elevated even though other companies are struggling within the index. So in a sense, the question isn't really, is the market expensive? But you can rather ask, are a handful of companies pulling the entire index upward? And right now, that answer is an increasingly yes. Finally, I want to talk about SpaceX stock. I made a video recently saying I was staying away from SpaceX stock for now, and that stance really hasn't changed. And even though the stock has rallied over 20% since it launched, I'm still seeing signs to be more cautious rather than going all in. Short-term momentum can be very powerful, and sometimes it just goes beyond what the fundamentals can justify. But in my view, there's still enough uncertainties in the expansion and valuation of the company that makes me more cautious rather than going all in. And when I wrote this script, SpaceX was a little high, but now today, it's trending a little lower, under that $200 mark. So overall, where does that leave us? We're not in a .com style bubble according to broad market metrics, but we are in a market where leadership is extremely concentrated, valuations are elevated, and AI is very much doing a lot of heavy lifting. The key question isn't whether AI is real, it very much is. It's whether the market is predicting too much perfection for far too long. And that's what we'll continue to watch. With that being said, would I recommend selling all my stocks in anticipation of buying the stocks back later at a lower price? Absolutely not. If you've seen my channel, watched me for a while, you know that the biggest generator of wealth is being invested over time in the market, through the ups and through the downs. Timing the market is not something that is worth missing the single biggest gain of the decade. However, having some more cash on the side to buy during a market downtown isn't a bad idea right now, something like 25 to 35%. Warren Buffett right now is sitting on a pretty heavy cash supply himself. That's it for this video, guys. Hope you enjoyed it. Please leave a like and subscribe if you haven't already. Enjoy the rest of your day and see you in the next video.